financial system isn't just wobbling. Frankly, it is flashing three huge emergency signals all at once. We've been looking at a stack of sources, and they tell a pretty undeniable story. We're talking a complete physical supply shock in precious metals, the world's biggest money managers repositioning for, well, crisis, and a $500 billion secret injection by the Fed.
It really feels like a moment where let's say, the mathematical reality of money is finally starting to overpower the paper promises we've relied on. We're tracking specific, quantifiable metrics here, things that point to a genuinely historic turning point. We're talking about massive institutional players, quietly abandoning decades of investment thinking because the basic math just doesn't add up anymore.
Right. This analysis is the knowledge shortcut you really need right now. We're going to synthesize these critical shifts for you fast.
And look, if you rely on this kind of quick, actionable insight to stay ahead, please remember to support the platform. Hit that subscribe button for Credvia right now. Seriously, it's how we keep bringing you this level of detailed analysis, pulled straight from the key sources.
Okay, let's unpack the physical market straight away. When we look at the source material, the weird things happening in silver seem like the clearest signs of deep structural stress. What are those undeniable signs of, well, physical panic?
Yeah, the clearest sign is simply that the physical metal is, well, vanishing. The most alarming data point we've seen is coming out of India. Now, India is one of the world's absolute biggest physical silver buyers. And for the first time ever, the country's largest silver refinery has completely run out of stock. Gone. This isn't just some local inventory issue, you understand. This is a global supply chain alarm bell ringing loud. Physical supply has just effectively dried up there.
Wow. Okay. Yet when we look over at the paper futures market, it still seems like, well, business as usual, or maybe dangerously unaware. How wide is that gap, that chasm between the paper promises and the physical reality?
Oh, it's enormous. The disconnect is huge. We see these managed money funds, right? They're holding over $1 billion in short positions on silver. That's often called the dumb money side of the trade. Basically, betting prices will fall. But the commercial banks, they're taking the other side, the long side. Now, if those managed money shorts are suddenly forced to cover their positions, maybe because they just can't find the physical metal to deliver, well, that paper imbalance becomes a real explosion risk for the whole market.
Okay, but if the physical scarcity is really that bad, why haven't we already seen some massive failure, a huge short squeeze? What's stopping the paper structure from just snapping right now?
Well, that's where you see the stress and the cost of keeping that short position alive, and the mechanics of how prices are set for future delivery. They're breaking down. Look at this term, backwardation. It sounds technical, I know, but basically, the LBMA, that's the London Bullion Market Association, it's been in backwardation for 18 straight days.
Right. For our listeners, can you just simplify what backwardation means in this specific situation?
Absolutely. Yeah. So normally the price for delivery months from now, a futures contract, is higher than the price today. That's called contango. It covers storage, insurance, Backwardation is the total opposite. Spot silver, the price to get the metal, right now today is trading a shocking $1.24 higher than the futures price. It screams physical panic. It means people are willing to pay a massive premium just to get their hands on the metal today, not 6 months down the road.
And the people who are shorting this metal, betting against it, they're being charged these crazy fees just to hold on to those paper bets, right?
They're hemorrhaging cash. Short sellers are paying something like a 19% annualized rate just to borrow shares of SLV. That's the big silver ETF they use for shorting. And on the wholesale LBMA market, the lease rate, the cost to actually borrow the physical metal itself, have hit an insane 39% annualized rate.
39%.
Yeah. A rate that high tells you the risk of not getting delivery is seen as so extreme that the cost to borrow the actual physical asset to cover a paper promise is just astronomical. This is not, a market functioning normally. This is a system breaking under intense stress.
Okay, so the market mechanics are just screaming stress.
Huh?
But here's maybe the more compelling part of the story. How the really big players, the institutional giants, are reacting. This changes everything, doesn't it? What are the key allocation recommendations we're seeing coming out of the world's biggest advisory firms?
Well, what's fascinating is that these huge financial players, they aren't waiting for the system to actually fail. They're repositioning now, based purely on the math. They're signaling to their big institutional clients that the whole way we think about managing risk has fundamentally shifted.
Let's get into the hard numbers then. Bank of America's forecasts alone are pretty eye-popping.
They really are. BofA just raised its silver forecast to $65 an ounce for next year, with an average price around $56.25.
Mm.
And they also lifted their gold target outlook to $5,000. But honestly, the real structural change is in how they're telling people to structure their portfolios.
It sounds like the old rulebook, that classic 60-40 model, is finally being torn up.
Completely shredded. Morgan Stanley's chief investment officer flat out declared the end of the traditional 60% stock, 40% bond model. Their new suggestion for major clients, get this, 60% stock, 20% bonds, and 20% gold. Now, you have to understand, putting 20% of a major institutional portfolio into gold, that's unprecedented. It signals these firms now see gold not just as some small hedge, but as a core piece for stability against, frankly, fiat currency risk.
And Michael Hartnett over at Bank of America, he pushed that protection even further in his big newsletter, didn't he?
Oh yeah, Hartnett moved to a totally different structure. He argued for a symmetrical allocation. 25% stocks, 25% bonds, 25% short-term treasuries, and 25% gold. Think about that. When the world's largest advisory firms are telling their institutional clients to park a quarter of their entire portfolio in precious metals, that's not market timing or speculation. That's preparing for a fundamental shift, a monetary regime change where the dollar's role is seriously being questioned.
And just to cap off that institutional shift, we even heard from the bond king himself, Jeffrey Gundlach, endorsing this kind of allocation.
That's right. Gundlach, the guy built his entire fortune on the bond market, right? He publicly stated that a 25% portfolio allocation to gold is not overweight in this current environment. So this convergence of thinking from bond legends to global CIOs, it strongly suggests the smart money has fully accepted that inflation and systemic risk are probably only going to accelerate. And you hear whispers. The top bullion distributors are reportedly targeting $6,600 gold as a realistic next stop. The whole consensus is shifting dramatically towards hard assets. Understanding the shift in institutional thinking provides immense value. And if you're finding this information necessary, please just take a quick second right now and subscribe to Credvia. Your support is what directly enables us to keep distilling these complex financial moves into clear, actionable knowledge for you.
Okay. So we've got physical metal under intense visible stress, and the biggest money managers are fundamentally changing their game plan. But let's connect this now to the cracks, the fault lines appearing inside the system itself. The banks. This banking issue seems far from over, and it's centered around collapsing debt, right?
Exactly. If we try to link this to the broader financial stability picture, the core problem is failing loans, especially commercial ones. Commercial real estate, but also residential mortgages, auto loans, we're seeing rising delinquencies, forfeitures across the board. Banks are holding increasingly bad paper, and that just eats away at their liquidity and, crucially, at trust in the system.
And that structural shift in office work, people working from home, that must be the biggest pressure point for commercial real estate specifically.
Oh, absolutely. The problem is structural. It's deep. We heard this anecdote, right? A major law firm in Minneapolis just abandoned 3 entire floors of prime downtown office space. It just highlights that companies realized they can be just as productive with remote work. They're ditching leases, leaving the banks who underwrote those massive commercial property loans holding a very empty bag.
And when banks start getting low on cash because of these unpaid debts and the collapsing value of CRE collateral, they turn to the repo market for those quick emergency overnight loans. What is the collateral they're using telling us about how desperate they might be?
This is probably the clearest indicator of real systemic stress. The repo market, remember, is where banks swap cash overnight for ultra-safe collateral. Traditionally, banks pawn off super safe U.S. Treasuries. That's the standard. But what's fascinating and frankly worrying is that the most desperate banks are now apparently pawning off risky mortgage-backed securities, MBS, instead of treasuries.
Okay, explain the severity. Why is pawning MBS instead of treasuries such a big deal?
Well, treasuries are like the gold standard of safety, right? Pristine collateral. Pawning off MBS, which are inherently riskier because they're tied to mortgages that could default. It's like going to the pawn shop because you're broke and you've already pawned your good watch. Now you're pawning the family jewelry, the riskier stuff you hoped you'd never have to part with. It signals an extreme acute liquidity crunch. It implies they've run through their best, safest collateral already.
And the Federal Reserve's reaction, even though it was quiet, seems to confirm they know exactly how severe this stress is.
The Fed's actions always speak louder than their public statements. They quietly injected almost $9 billion into the system recently. But much more critically, they opened up this massive, almost $500 billion emergency lending facility, over $490 billion, basically under the radar. You simply do not deploy emergency funds of that magnitude and do it secretly, unless you are terrified of a collapsing confidence in the underlying financial plumbing. It tells us the systemic problems from previous crises weren't really solved, they were just papered over, patched up, and maybe hidden from view.
So let's bring it all together. What does this mean for you, our listener, as we synthesize these three huge shifts? We've got a physical metal market seemingly collapsing in on itself, India running dry, lease rates exploding. We have institutional giants allocating 20% to 25% of portfolios to gold, fundamentally rewriting investment theory on the fly. And we have banks struggling so badly, they're pawning risky assets while the Fed quietly opens the taps on $500 billion in emergency cash.
Yeah, the core message here is really shifting away from just price speculation. It's becoming about trust. This analysis shows the market is fundamentally losing trust in the dollar, losing trust in the banking system, and losing trust in those paper promises. As the sources we looked at point out, you can try to lie about inflation, but you can't lie to mathematics. When the fundamental math on asset values and loan risk breaks down, the financial system inevitably has to follow.
And we saw the immediate effect of this underlying stress just last week, didn't we? Gold got hammered, crushed by over $100 in one day in what looked like a paper raid. Yet it bounced back 108 within hours. That instant, powerful buying just tells you every dip is being met immediately by aggressive physical demand, people desperate to secure actual metal. The system is structurally stressed, and it's becoming incredibly volatile.
And the potential for systemic contagion here is very real, because the same big banks that are, say, shorting physical metal are the ones playing in these increasingly risky repo markets. If just one major bullion bank were to fail to deliver physical metal when called upon, that failure could potentially ripple through every other part of the financial system they touch. It's all interconnected.
So the final provocative thought we want to leave you with today is this. If the Federal Reserve is being so incredibly hush-hush about deploying a $500 billion emergency facility, what truly catastrophic level of systemic risk are they currently trying their absolute hardest to keep hiding from the public eye?
We track every market move, every institutional shift that's shaping the future of money, metals, and the markets. If you appreciated this synthesis of information, please make sure you don't miss our next analysis. Join the conversation, support the platform, just hit that subscribe button for Credvia right now.